Hello, everyone. By way of introduction, my name is Hugh Wedlock, and I'm Director and CEO of the Fry Group in Singapore. And I'd like to welcome you all to today's webinar, where we'll be discussing both investment and markets. Now, our objectives behind doing so are twofold. Firstly, to give you a feel for the way that Progeny Asset Management invest money, scale of their team, and the types of investment solution that they run. And secondly, to give you an investment market update. So where are markets right now, and where do we think they're headed in the future? How are we going to do that? Well, let me talk you through our agenda for today. Here it is. We're going to start with a reminder of the Fry Group's investment principles, and then we'll move on to introduce Progeny Asset Management and the value that they can add from an investment perspective. We'll then cover structure and governance, and then finally, we'll update on investment markets. There'll also be time for some questions and answers, which I will moderate. Let me introduce our speakers for today. I've got a couple of subject experts with me, and there they are. Firstly, Ian Hooper. Ian is Chief Investment Officer at Progeny. He's based in Leeds. And Charlie Buxton, Head of Investment Management for the Fry Group. Charlie's based in Hong Kong. So the two guys are going to talk for about 40 minutes today, and then, as I said, we'll have time for Q&A. If you have any questions that you would really like answered through the course of the presentation, please feel free to put them in the normal place, which is in the question box at the bottom of your Zoom screen, and we'll try and get as many of those answered as we can at the end of the session. We're expecting today's session to last 1 hour in total. So with that, I'll hand over to Charlie Buxton, who's going to begin by talking about the Fry Group's investment approach. Charlie, it's over to you.
Okay, thanks, Hugh, and good morning, good afternoon, or good evening to everyone, depending on where in the world you are. As you mentioned, my name is Charlie Buxton, and I head up the Fry Group's investment management team, and I'm based in Hong Kong. So, as the two businesses come together, investment is one of the first areas that we've looked at, and was an obvious place to start given the similarities around our investment principles. So I'm just going to briefly remind everyone of what they are. First and foremost, we focus on long-term strategic asset allocation. So a focus on the long term, not trying to time markets or be distracted by short-term noise. We're looking to construct a well-diversified portfolio for our clients using a combination of equities, bonds, and alternatives. In other words, we're trying to create as smooth an investment journey as possible. Now, within each of those asset classes, we decide where we want to be positioned relative to a mainstream global benchmark. For example, with equities, which regions do we want to have more, less, or neutral exposure to? Sectorally, this is all about ensuring that we don't have concentration risk running through the portfolios. So we're not overly exposed to any one sector, such as financials, healthcare, technology, whatever it might be. In other words, we're not looking to put our eggs all in one basket, which is the premise of a well-diversified portfolio. Now, stylistically, we're looking to achieve a good blend between value, growth, and any other types of style managers. So, for example, value managers might be looking at companies that trade at a discount to their intrinsic value, whilst growth managers typically look for companies that are growing their revenue, profits, or even cash flow at a faster than average pace. Now, at varying times in the economic cycle, different styles will come into play, although we don't know when, and hence why we like to blend manager style. Now, really clearly, very aware of just how much cost can impact portfolio returns. So we therefore don't look to include active managers where we don't believe that they can deliver consistent long-term outperformance. Now, a good example of this would be the US, where in the large cap space in particular, active management has consistently underperformed its benchmark. Now, to help with all of this analysis and construct, particularly when picking the underlying investments, we look for quantitative analysis, which is supported by research tools and screens to narrow down the investment universe, alongside qualitative analysis, which is the human overlay. So now I hope that's given you an idea of our investment approach. And with that, I'm now going to pass you on to Ian to provide an introduction to Progeny Asset Management.
Hi everybody, I'm Ian Hooper. I am the Group Chief Investment Officer for Progeny. I'm going to speak now a little bit about Progeny Asset Management and our investment proposition and our investment philosophy. And at Progeny, we think of investments as the engine to meet your financial goals. We are a business where we've got clients with financial planning needs, and we need to help you solve those problems. And that's how we think about investments. So where do I fit into the group? Well, I'm on the management board of Progeny, and I oversee the asset management side, the discretionary fund management, and the asset management side, the fund management side of the business, but also anything to do with investments on the wealth side, the planning side I also get involved in. So all things investments come through me at Progeny. So to start with, I'm just going to go back in time to when I first got introduced to Neil Moulds, our Chief Executive Officer for the whole group. And Neil spoke to me about this vision of Progeny, having this multi-advisory platform where we've got sort of financial planning at the centre, but around it we've got tax and legal services, but also asset management, this engine to meet those financial goals. And he described to me how this would come together, and that's why I got involved in the business, and I've been in the business now for 8 years. And I think the best person to describe that coming together of Progeny is Neil himself. So we're going to play a short video who's going to bring to life the coming together of Progeny.
Look, Progeny was created out of a desire to bring together professional advisors into one room. You know, looking back a few years now, when we first set out the vision for Progeny, we spoke to clients, we chatted to them about their frustrations about professional services, and having to go to different advisors in different locations, tell the story again, get another fee quote, get charged something else, and ultimately never really get the one piece of great advice because it wasn't delivered together in collaboration with other professional advisors. So the ability to bring all that together into one place, first of all, removes a lot of the barriers for clients in terms of their confusion. But ultimately, I believe it delivers a better outcome, because I believe we're moving, whether it's legal, whether it's tax, whether it's financial planning, we're taking that advice, which was always delivered very much in silo. First of all, we're bringing it together, and then we're lifting it up. So now when we're creating a financial plan for someone, we're looking at their legal requirements from a private legal, trust, inheritance tax point of view, talking to tax advisors, creating the goal-based cash flow model over here. But actually we're doing it all up here. We're not just focusing on one aspect. So ultimately now I believe we're delivering even better outcomes for clients as that advice becomes even more holistic.
So I think Neil's just really described very well. We wanted to create Progeny to get a better client outcome. And investments is a big part of getting a good client outcome. And when we first met the senior management team of Fry Group, we looked at the business. And I think as Charlie's alluded to already today, there was really a strong alignment around investment thinking. And what I wanted to do was help build on those strong foundations. And as the teams come together in the new world, really offer clients a better choice of investments and solutions to meet their financial goals. So how are we going to do that? So I'm just going to talk through that now. Well, it is a scale story in lots of different ways. So firstly, we've got some great people in Fry and some great people in Progeny Asset Management, and we're going to bring those together. So we're going to have a larger team to run lots of different solutions, because we are investment style agnostic, because clients come to us with different financial problems and goals, and they need different investment solutions to meet those goals. So we believe we can apply our investment philosophy, again, which strongly aligns to what Charlie has spoken about this morning, and create the solutions that meet those goals. And over time, as our assets have grown, we've been able to turn our solutions into fund ranges. Now, what does that mean? Well, it means that we can trade within a particular structure that is very efficient for you as the client. There's no capital gains tax consequences if you're in the UK for doing those types of transactions. It also means, very importantly, we can control the value chain. So what does that mean? We can go to the fund management industry and demand a better deal. So we can control the price point for clients, and obviously that's part of getting a better outcome for you as an investor. Of course, performance is really crucial as well. So add performance and cost control, and that is really effective investment story. And really that's all come out having our own range of solutions, which is really important. Really important though, it is tailored to your financial plan because every client's different. So we want the best range we can for our clients to meet those financial goals. So let's put some numbers behind that. So today within Progeny, and if we include the FRI assets in there, there's DFM, discretionary fund management, and fund management assets of 3.6 billion. We've got 13 specialists, investment specialists within the business. And if you do the mathematics here, so it works out about 10 years average experience, which is great to draw upon. And that's been enhanced by the FRI and Progeny teams coming together. We've got over 5,000 clients just in Progeny Asset Management today, much bigger number right across the whole group. And we're working in very specialist teams. So you've got portfolio managers like Charlie, with then investment support and analysts and research that sit beneath that to ensure that there's focus on the different solutions that we do. So what are those solutions? I think Charlie touched on this. Well, we go everything from passive solutions. I'm going to talk around how we think about that in a little bit. We've got smart beta solutions or systematic. So this is very much a form of active investment, but you're using academic empirical evidence to sit behind your investment processing. If you want to look it up, you go and look at Farmer French. That's the economic theory sat behind it. And it all ties into US markets and having a bigger weighting in smaller companies and value companies over the long term. They add a premium to your return. So it's based around that level of thinking. And then you've got active management, which we sort of see best of breed, where you can take all that good stuff, put it together, and we expect a higher return for using the best of breed approach. Again, we'll call that active for today. So to do that, we need the specialist teams, and important part of that, of course, is international. And we've got Charlie on today, and there's an international footprint now within Progeny, and brings a host of a wealth of talent to the business. So, okay, this is all great stuff, but it needs to be overseen and administered properly. And so strong investment governance is crucial when you're running a business the size of Progeny. So in the last couple of years, what we've done is completely redefine our governance structure around investments. So on the one hand, we create investment solutions. We're a manufacturer of investment products. And so the manufacturing side of Progeny, which is Progeny Asset Management, has 3 committees just to run the money. So you've got an investment decision-making committee, which is the day-to-day making decisions on investments. There's the investment committee where I sit and really chair and challenge the decisions made around investments. And I can draw on some real talent externally of experts from the city and from the industry to help me validate and challenge what the investment team are doing. But then I get challenged by our Chief Risk Officer in our risk committee as well, that we're ensuring that our investment proposition sits within our risk boundaries. We are a risk-based business, and we need to ensure that we stay within risk at all times. And we all know there's a few horror stories across the industry where risk controls haven't been put in place, and it's important that we have that step in our process. There is this ethical line that separates out then distribution. What is distribution? It's the financial planning side of Progeny, and that's where you see your financial planner and they talk to you about solutions and giving you investment advice and something that meets your financial goal, and that has its own investment committee. I sit on that as the group CIO to understand what planners want to see in terms of investment solutions for you, the clients. So a very important forum, but a different forum and separated away from what happens on the product development side. So again, really important that all those things are in place. And we'll continue to enhance that and improve that over time as we grow as a group. So I think it's worth just sharing some of the external knowledge and talent that I can bring into those investment committees. So we've got Andrew Milligan, who joins as the sort of macro specialist. So we are a top-down investment business. So what does that mean? It means we look at the global economy, and that drives our investment decision-making. And Andrew was, he was the head of strategy for Aberdeen for many, many years in the UK. And he brings a wealth of talent and knowledge and a lens on that macro environment. We've also got Tim Hale. So I referenced before systematic smart beta, this farmer French sort of form of active management. Tim and his team at Albion Consulting are very much the experts in that arena. And they also do a lot of data validation. So we've got a third party showing that our solutions are robust, they do perform well against benchmarks, and they stack up well against the industry. And that's really important from a performance perspective. And then we've got James Maguire. So James recently joined from UBS, and he spent the large part of his career at UBS in the fund management space. So from fund sales, fund distribution, fund research lists, and he had a very senior role there. So James brings that, as we've moved into this fund management group, he brings that fund management lens to the committee and challenge. And again, great insight and knowledge as well that we can share. And finally, we've got Andy Raby. So Andy's background is trade execution. He was head of a dealing desk for many, many years. He also knows the rules around, certainly in the UK, around trade and execution and the wider rules around the FM world. So Andy's the sort of guy that if there's a paper come out from the FCA, trade bodies will draw on his knowledge and experience to get a view on that. So again, this is a great forum for me to draw on and challenge the investment arena that we've got here at Progeny. So I think let's just move on now in terms of back to this idea that investments are an engine to meet a goal. And your experience as you come into Progeny, as the business has come together, is it should never be a financial planner comes and talks to you just around a strategy, just about trying to meet a particular financial goal. We should be talking around a philosophy first. And this is the basics of running money. It's amazing over my many years in the industry how many businesses don't follow a philosophy and don't follow rules. And this is when we were talking with the board at Fry and the things that Charlie's spoken about earlier, that Fry were doing some of these things already. Everything that you see, marketing collateral on websites and the look and feel of things at Progeny will always have the philosophy that you can see here. And yeah, diversification. I mean, I'll just pick up on that from what Charlie was saying. It's amazing how many businesses don't diversify well enough in terms of diversifying risk. And I said earlier on, we're a risk-based business as a group. And so it's important that we apply this philosophy. I think it's the application of the philosophy that's really important because I think Charlie and I will agree, as investment people, what are we here to do? We're here to provide you with a smoother investment journey. And sometimes markets, as we saw in 2022, they don't act in a rational way. We have this strong correlation between equities and bonds, which hadn't been seen for many, many years. And when things like that happen, that's when you need these practical imperatives to sit behind your philosophy. So yes, as Charlie's talked about earlier on, getting the asset mix right, diversifying away risk. And as I've touched on earlier on, that management of financial costs and this buying power that Progeny can bring when they're coming together with Fry is really important because we control that value chain and control the cost budget. Now, your financial planner and the people that you meet within Progeny tend to be the financial planners and helping you solve your goals. And they can help you manage those emotional costs. Because back to 2022, markets didn't behave as we expected them to, and we saw some volatility in markets in the short term. Now, this is noise, okay? And we'll come on to that maybe later on today. But that's the time to manage those emotional costs. And that's built into our philosophy and the way we apply investment thinking, and that should flow through to your financial planner when you're talking around your financial circumstances. Last point, really basic point, but again, not always applied well, is rebalancing portfolios back to the risk score you said you wanted when you met your financial planner. And we rebalance quarterly on our solutions. So there's nothing more to it than keeping you as a client in the risk score you said you wanted when you became a client. So again, really, really important and a really basic thing for us to do. So the last point from me is, again, coming back to that investment being the engine to meet your financial plan, and how does a financial planner at Progeny have that conversation with you? Well, let's think about this. We've got your financial plan at the top, and what are your choices? Well, you can buy an index, can't you? You can buy an index, and that's your starting point. So if you just track that index, which is passive investment, you get the return of that index less the costs. And in some occasions, that will meet your financial goal. So why look for anything else if that's the solution to meet your goal? So it will be cost effective. It won't beat the market because there's costs in terms of actually running the passive, and the expected return tends to be lower with that style of investment. So then your financial planner goes, actually, you need a little bit more return, a higher expected return. How do we do that? So back to that smart beta systematic approach where we make a slight variance to the index, small cap and value. Actually, within systematic, we do more than that. So small cap and value and different factors that we use, might be growth or momentum. Again, some of the things that Charlie's talked about earlier on. And that can create an incremental higher expected return. And that may well be enough for you to meet your financial goals. So that extra work comes at a little bit extra cost. So the costs go up a little bit, but the expected return goes up a little bit. And finally, then we've got active, which is a bigger variance to that broad market index. And here we're using the team using a much more tactical approach to try and create a higher return for you as the investor. So there'll be a higher tracking error to the broad market and a higher expected return, but therefore for all extra work, there's a higher cost. And that's really how we think about giving that investment advice from a planning perspective. So just to finish what I've said there, there's clearly a strong alignment with Fry and its investment philosophy. And we believe we can build on these strong foundations as we come together as a business. And I've spoken today about the additional options available now to you as clients in terms of that fund management range, the cost control and controlling that cost budget. We have a global outreach as a business as well. So it's really building on top of all that good work that Charlie and the team have done, and in the future offering you a wider choice. And again, back to what Neil said, that enhanced client outcome is really, really important. Now, of course, none of that sort of makes any sense without understanding markets. So I think this is a great time to bring Charlie back on and let him talk through the market outlook for this year.
Okay, thanks very much, Ian. So look, as we approach the end of the first quarter for 2024, I think it's important to remind ourselves of what the market backdrop was going into it. So in other words, a small reflection on 2023. Now, as you can see from the chart in front of you, clearly there's a big divergence regionally between what the US, the black line, led by mega cap technology-focused names, and other equity markets and asset classes delivered. Now, by this stage, you're probably all very familiar with the Magnificent Seven, which is a segment of the US equity market consisting of 7 companies which last year delivered outsized returns based around hopes and expectations for artificial intelligence and the potential there to grow revenues significantly into the future. So subsequently, much of 2023's rally was concentrated across those select few companies. Now, towards the end of the year, the equity rally broadened out a little bit, predicated off more encouraging inflation data in the US and a subsequent expectation for interest rate cuts going into 2024. In some cases, the market rather optimistically anticipated as many as 6 to 7 rate cuts by the Fed, or the Federal Reserve, I should say. So whilst the chart clearly shows positive performance amongst equities, it belies some of the challenges that investors faced, most notably amongst smaller banks and their exposure to longer dated US Treasuries around about this time last year. I think we'll all remember SVB and how the regional banking crisis spread to Europe. There was conflict in the Middle East from October. And finally, and this was something that gripped markets throughout the year, and that was the persistence of inflation. So it was an area of discussion which never really went away. And for those of you that are hoping it does, I suspect it won't this year either. As you'll see from the chart as well, in turquoise, the UK was a slight laggard with 2 straight quarters of negative growth towards the end of the year. Now, typically where homeowners in the UK have mortgages, they have more exposure to variable rate mortgages, and consequently they feel the pinch from higher rates all the more. If you compare that to US, a lot of US mortgage owners actually have fixed rate mortgages going somewhere into the future. So they don't feel the effects of higher rates to the same extent as those in the UK do. Now, finally on bonds, the red line, higher for longer, was very much the narrative around interest rates across all major developed markets, except for Japan in 2023. And this typically hurts bonds, which pay a fixed rate of interest and are therefore more adversely impacted when rates move higher. And this is something that I'll come on to shortly. Okay, so where are we at now? If we move to the next slide, you'll see year-to-date performance. And what I think stands out is that divergence between equities and bonds has continued. Bonds continue to struggle in light of some still high pockets of inflation. And there are varying sort of areas of where this inflation lies, but it typically is coming from the core services sector, which represents around 61% of the consumer price index, where the likes of shelter costs, which includes rents, remains high. So this is the challenge that is facing central bankers. There are still pockets of inflation that haven't yet gone away, or gone away to the extent that they would like to see. Equities continue to do well, supported by strong global earnings estimates. So we're looking at around 7.7% roughly estimated earnings growth for global equities this year. And that's also coming ahead of analyst expectations. Now, this was also helped last week by the latest dot plot projections, which is basically where members of the Federal Reserve anticipate where rates will be at the end of this year, next year, and further out into the future as well. And this was arguably more dovish and supportive to markets than what had been expected. However, it is worth noting, and I think this is a key point, that still half the members believe there will be limited scope for rate cuts this year, whilst the other half expects consistent rate cuts throughout the year. So there's still a little bit of division even amongst the Federal Reserve members at this point. But for the moment, the market is buying the dovish signals supported by that other half of the Federal Reserve Committee. Now, some nuances have emerged amongst those Magnificent Seven stocks that I mentioned earlier, and some share prices have fallen off a little bit. So I'm thinking Tesla and Apple, which have had a slightly rougher start to the year, whilst others such as Nvidia continue to steam ahead. So at current valuations, the top 10 stocks in the US equity market are now trading at around 25 times their expected earnings. And I think there's already been a question submitted on this and valuation levels, which we'll address later on in the webinar. More broadly, though, global equities continue to perform well, and that's supported by strong momentum coming from Japan, India, and Europe, amongst others. Now, where I'm based, China remains a challenge, although lately we have seen a little bit more policy support forthcoming. So that's where we are as we approach the end of this first quarter. So, you know, there is still that divergence in play. But what I really want to focus on next is why are the Fed at this point still reluctant to cut interest rates? So if we move to the next slide, fact is that in spite of these higher interest rates, the chart shows that the US economy is continuing to perform well. So you'll see there that the last 4 quarters in particular have shown a re-acceleration of GDP growth, which is exactly what that arrow is pointing to. Now, more broadly, the US has grown its GDP at around 8% in real terms, so after inflation, and that's since the end of 2019. So it's therefore the only major economy to be back to pre-pandemic growth levels. Therefore, and as a result of this, the Fed has not had to worry about the impact of higher rates because the economy has continued to perform well. Typically, a central bank would look to reduce rates if the economy was slowing down, but that's not what we're seeing. So why is that? Well, US unemployment levels remain at close to a 50-year low, still under 4%, and that's as a result of various factors. The first of which is all the stimulus doled out by the Trump and Biden administrations at the height of the pandemic. So that's still working its way through the system. We've also seen major spending packages approved by Congress on infrastructure, clean technology, and semiconductors. And productivity levels are higher at this point in time than historical standards by about 1 percentage point. So productivity is also helping deliver an improved and more efficient economy at this point. Now, energy was a big talking point in 2022 and 23, and it still is. And it's always worth noting who the big producers of oil and gas are, and the US happens to be one. It produces a fairly significant chunk of natural gas globally, and currently it's costing US consumers about a quarter of what it does in Europe. So they're not feeling the pinch in the wallet as much as those in Europe and elsewhere. So not only have these factors supported stock market growth, they've also countered the need at this point in time to reduce interest rates more quickly. If we think about bonds, moving to the next slide, there's been a lot of talk more recently about investors becoming more and more interested in bonds after more than a decade of fairly negligible returns. So why is that? Well, this chart clearly illustrates the potential for positive returns from global and UK government bonds, as well as global credit, as and when cuts do finally come. And this is what's getting investors excited. So since the onset of inflation in early 2022, so almost 2 years ago now, exacerbated by the huge swathes of fiscal and monetary support during COVID, followed then by the conflict in Ukraine, inflation raced higher, meaning that interest rates had to move higher in response to this. In other words, trying to bring about more restrictive policy to stop inflation spiraling out of control. Now, as I mentioned earlier, given that bonds pay a fixed rate of interest, the higher interest rates go, the less appealing bonds become. Conversely, when you do see a decrease in rates, or at least expectations around rate decreases, this typically supports returns. And this is essentially what the chart is showing you. Lower interest rates are positive for bonds, and this is the potential return that they can offer. And this is far greater than it's been ever in the last decade. So that's why investors are starting to get excited about bonds again. So looking ahead, if we move to the next slide, what do we expect for the remainder of the year? I think first and foremost, we're expecting inflation to moderate, although how that looks is probably likely to be bumpy. And if anything, the last year has shown that it's very much unlikely to be a linear kind of downward trend in inflation. There are still bumps out there. As I've talked about, core services inflation remains problematic. We expect a slight uptick in unemployment as the delayed impact of rate rises starts to come through. So don't forget, it's now almost 2 years to the month when the Federal Reserve and other central banks had to start raising interest rates. And typically, you see a bit of a lagged effect as to when they feed through into the real economy. However, with inflation coming down, this should support real disposable incomes, which have also been helped by wage growth remaining fairly steady at this point. As we said before, certain areas of the bond market now look attractively priced. And if we think about the 10-year Treasury yield and where it's at now, it's not been at these levels since November 2007. So it's offering at this point in time the best value that it has in years. However, it's important here when you think about bonds to be selective. And that's something that I'll come on to later on. And finally, as investors are all too aware, the performance of certain segments of the market has understandably led to some concerns over concentration risk. And as investors understandably look to reallocate away from this risk, I'm thinking particularly around the Magnificent Seven, we'd expect returns to broaden out. So not just to be focused around any one sector, but to start including other broader sectors across the economy. Well, what are the risks? Well, there are plenty of risks still out there. And I think first and foremost is that the Fed does not have a good track record of anticipating inflation and reacting in a timely manner. And I think if we think back to August 2021, we saw that as a prime example. Now, there is therefore room for a policy misstep with interest rates forced to remain higher for longer. And that's certainly something that investors need to think about. As I've said before, the path towards getting towards that 2% inflation target is not likely to be straightforward, and it hasn't proven to be so far over the last couple of years. Also worth bearing in mind that there are still potential concerns around auto loans and delinquencies on credit cards, which soared last year and rose to above pre-pandemic level highs. So that's just something to think about at the back of people's minds. You know, people struggling to pay back their credit cards on time, is that a sign of financial strain? If we think and compare it to around 2019, then arguably we could say it is, and that's something to be mindful about. And finally, and I think again we've got a question that's been submitted on this front. As we're all too aware, we've got plenty of elections on the horizon. Over half of the world's population go to the polls this year, and that will no doubt create plenty of noise in markets if it hasn't already. We simply can't predict what will be the outcome of these elections and what that will mean for stock markets. What we do know is that historically, in amongst the volatility, markets have ultimately continued to trend upwards. So how are we positioned for all of this? If we think about equities, whilst we're neutral at asset allocation level, we are, however, more constructive on emerging markets and UK equities. In emerging markets case, GDP forecasts continue to look more promising than in developed nations at around close to 4%, whilst a weaker dollar as rates trend downwards is also typically supportive for them. In the UK, valuations still remain low, especially in the small and mid-cap space, which could be supported by more imminent rate cuts following last week's Bank of England meeting. So some of you might have read in the papers that the Bank of England met last week, and it was there revealed that previous proponents and previous advocates of a rate hike had in fact shifted their thinking around this, their stance, and are now forming a majority who are likely to favour a rate reduction around mid-2024. So in other words, we're looking at a potential cut in interest rates around June time this year, and I think that could be a welcome fillip for markets. Now in the US, obviously the major global market, economic data, as I've said, has been stronger than feared, and the soft landing scenario is more likely. Now, what does soft landing mean? We hear all these terms, soft, hard, no landing. Essentially, a soft landing is where inflation continues to trend downwards following the rate hikes that have been affected over the last 2 years, but it doesn't hurt economic growth. So that's why it's referred to as a soft landing. Now, rates should fall. This is what we're expecting as inflation moves lower, and that should help to boost earnings. On bonds or fixed interest, I think earlier I talked about the importance of being selective when it comes to bonds. And we think that with a recession less likely and default rates likely to remain low, high quality corporate bonds appear attractively priced and yields still remain generous. Now that also explains, and I'm sure if you would have read this in the FT earlier this week, why corporate bonds have seen the current year-to-date inflows that they have, particularly in the US market. Investors still favour this as an asset class, but they prefer the degree of quality you get from investment-grade bonds over what you get with high yield. So in the high yield space, the additional risk undertaken here over investment grade does not adequately compensate you for the risk taken. In other words, it offers a poor risk premium. And finally, on alternatives, we're marginally underweight on alternatives as the positive correlation that emerged between equities and bonds through 2022 and some of 2023 has started to recede. That said, we cannot forget their importance when inflation shocks in 2022 actually brought those correlation levels between equities and bonds together. So we still advocate having some exposure in this space, be that through absolute return strategies, infrastructure, or some indirect exposure to commodities too. So that's how we're positioned, and I hope that's given you a good flavour of where we're at. And Hugh, with that, I'll pass back to you.
Thank you, Charlie, and thank you, Ian, for your presentation so far. So now we're into questions and answers, and I'll ask Ian to come back in. And I'll also mention to everyone who's on the webinar, please feel free to add any questions that you have into the Zoom box at this stage, and we'll try and get as many of them answered as we can. So let's get straight into it. And we're going to start by sort of talking about macroeconomics and interest rate policy. And Charlie, it's a question for you. The Financial Times over the weekend was full of the concept of immaculate disinflation. The concept being that central banks have managed to stop or arrest inflation or the rise in inflation without any perceptible effect on employment markets. And with CPI in the UK at 3.4%, in the US at 3.2%, that appears to be the case. Do we think immaculate disinflation is happening, Charlie? We'll let you answer that one first.
Yeah, thanks, Hugh. I don't think anything about markets is immaculate, and I think when we look back at inflation over the last couple of years and how wrong the markets have been calling it, expecting inflation to trend lower, and then all the surprises that have come through in the data, that suggests that immaculate disinflation is something of a whim. What I would say is absolutely true, and it's a very good point in terms of the employment markets remaining fairly resilient, particularly in the US, as I touched upon earlier, but also in other parts of the world as well. So if we think about the UK unemployment rate, for example, that was much lower late last year than previously thought. So I think the latest data shows unemployment there at around 3.9%. But whether inflation has stopped, now that's the main challenge, and that's what's facing central bankers at this point in time and has been for the last 2 years. As I mentioned earlier, service inflation, that includes shelter and rents, that remains problematic. And I think that's ultimately the segment in the market that is preventing the Fed at this point in time being able to cut rates. Now, given the supply disruptions in the last 4 years as well, obviously since COVID, I think the supply-demand dynamics will take longer than anticipated to normalize. And in fact, I think we're probably in the midst of establishing a new normal, given that trade tensions have started to re-emerge again between the US and China, as well as the various conflicts we've seen in the Middle East and Ukraine. So I think, getting down to immaculate disinflation is, in my eyes anyway, nigh on impossible, given what the macro backdrop is. But I think the positive point here is that at least inflation is trending lower, and we know that at some point central banks will be able to cut. So yes, great, unemployment has remained fairly low. We're seeing that in the data, but in terms of that immaculate disinflation, I think that's unlikely at this point.
So you mentioned kind of supply and demand balance a second ago. A lot of the inflation that we've seen over the last couple of years has been caused by supply shocks rather than too much aggregate demand. Do you think the global economy is through the worst of those supply shocks now?
Yeah, it's a good question. It's not. No, I don't. Is the answer. I think there's still plenty of troubling aspects in the global economy which we need to think about, and that's something we all read about in the news daily. So whilst the COVID supply shocks may have abated, other factors have crept into the fold. As I mentioned earlier, the increasing geopolitical tensions that we're seeing between major economies, the US and China being a good example of that. We're seeing increasing protectionism. I think COVID also taught all sorts of different countries the need to actually onshore a lot of their production. They can't rely too much on extensive supply chains. They've had to rethink how that works. So it's not just COVID though. It's the war in Ukraine. It's the conflict we're seeing in the Middle East. These have all kind of made people think about the supply chain dynamics and what they're exposed to. So I don't think to that extent we're through the worst of it, no. But I think where we do have some good news, particularly in the US, is around production levels. Now, those have actually increased significantly in the last few years, which has supported supply chains. So we're seeing increased efficiency from the world's leading economy. And I think that can only be a good thing. But I also think in terms of that demand picture, as the restrictive policy that we've talked about so far this webinar recedes, so as interest rates start to come down, then we should see aggregate demand start to pick up. Slightly easier monetary policy is typically a beneficiary for the consumer wallet. So no, I don't think the supply shocks are over, but I do think demand should start coming back as rates trend downwards.
Okay, thanks, Charlie. So we're going to move on now to talk about specific asset classes. And I'll bring Ian in here. Ian, thinking about what's happened over the bond market over the last couple of years, a little bit of hostility coming through as regard the fixed interest space. Question is there any value in gilts or bonds anymore in order to diversify risk? In recent years, more bond-heavy portfolios have fared the worst in the bad times and been the slowest to recover in the good times. So why invest in gilts and bonds at all anymore?
Yeah, so really good question. Topical 2022, I referenced it earlier on, and I was speaking around how the correlation of equity and bonds came very close in 2022. They both fell in 2022. And there was a lot of comment in the press about the 60-40 portfolio, 60% equities, 40% bond portfolios falling together because of the factors around the market that were driving that at the time, and obviously the speed of interest rate movements upwards. That did surprise the market. So back to the question, is there value today? Well, I think the slide towards the back end of Charlie's market update was a really nice summary of that, because it just showed the benefits of a rate decrease for corporate bonds, but also gilts. So 1% decrease would have a very positive effect on bond returns. Picking up on what Charlie said earlier on, is we agree that investment grade is probably the place to be at the moment because of the strength of corporate earnings. Obviously, Charlie referenced the US. At the start of this year, I did my sort of market look ahead in January for this year, and I think I actually said in my first market commentary, bonds are back. So I think that sort of answers the question, doesn't it? Bonds are back. Investment grade very much we see as the asset class right now within the fixed interest space. I think gilts have their place, really more as a security policy. If the soft landing doesn't quite play out, you're going to want the most secure assets, and that's US Treasuries and UK gilts. So we maintain a position underweight, obviously, to investment grade bonds. But as I say, back to what I said at the start of the year, bonds are back. So I think that answers the question.
Thanks, Ian. So Charlie, coming on to equity then. You had a slide earlier on, which when it went through the major asset classes, said that your view on equity currently was neutral on the whole. But what specific parts of the equity market do you think offer comparative value in your view right now?
Yeah, it's a good question. Look, I think when we think about where value currently lies in the world, clearly there's been a lot of challenge in the US given where valuation multiples are at. So consequently, we actually quite like emerging markets. Clearly, they're at the moment being driven to a large extent by India and the growth story that we're seeing there. And I suspect that growth story will continue to increase as the election comes and goes, and more policies favour businesses throughout that part of the world. Don't also forget that when interest rates in the US start to trend downwards, that's typically a positive for emerging markets. If you think that a large portion of their debt amongst these emerging economies is denominated in dollars, a weaker dollar is typically more supportive for emerging market equities. So I think emerging markets more broadly. As I mentioned earlier, China has had its challenges, but a lot of the fund managers we speak to are starting to see some value in there as well. So I think when you combine China from a valuation standpoint and India as the growth engine of emerging markets at the moment, there's still some good value to be had there. I equally think, when you look at the UK and just the kind of low multiples that it's trading on at the moment, there is some value there. You haven't seen these kind of levels of valuation in a long, long time, and particularly in that small and mid-cap space. So I think from that point of view, there's value to be had. And as I referenced earlier, the economy is actually starting to come back a little bit. So we're seeing unemployment at 3.9%. We're seeing the Bank of England getting a little bit more comfortable with inflation and talk of rate cuts more imminently than the market initially expected. So if we think about last week and what the rhetoric was coming out of that, Andrew Bailey, the governor of the Bank of England, was very clear that actually rate cuts might come sooner than the market had initially anticipated. So I think that will also be a positive for the UK market. So where do we see opportunities? Essentially, it's emerging markets and the UK.
Thanks, Charlie. One more question on equity, I think, and Ian, I'll direct this one at you, if I may. Quite a few people sort of pointing out that valuation multiples in the broader US equity market are high. They're even higher if you kind of think about the tech sector. And the kind of gist of these questions that we're getting is, how expensive are these markets? Is that the kind of valuation multiple that I need to pay for a growth stock now?
Okay, very good question. So let's think about the US. So where are we positioned to the Mag 7? Charlie's talked about a little bit today that we're relatively underweight the Mag 7, because let's just deal with that point. They are running ahead, running quite hot in terms of valuation terms. And there's no doubt that the technology that the 7 have are embedded in our global infrastructure. So showing my age a bit, I was around in 2000 with the technology boom, and there was lots of businesses there on some crazy PE multiples that never made a profit and unfortunately are no longer with us. That's not the case here. So just to be absolutely clear, the Mag 7s are going to have a place in our global infrastructure going forward, but they probably run ahead of the curve a little bit at the moment, and that's why we're underweight to those within portfolios. I think the difficulty comes then about where do you position yourself around the US, because the US is by far the biggest equity market and dominates the world index. So again, we've just changed our positioning to be neutral on the US. We were relatively underweight, but where we're seeing value is in actually some of those small and mid-cap areas. So what we've done is we've added in some smaller mid-cap companies in the US, where actually, if you look at their valuation multiples, they do look like there's some value there. So it's finding that pocket of value, if I may, that's really important. Buying the market as a whole is a bit more challenging because you're actually driven by 7 stocks, and that's something like I saw in the press. 15% of world markets is with 7 stocks. I mean that feels a little bit toppy. I think it's been selective, if I may, on that, on the US.
Okay, thanks, Ian. Charlie, can I ask you for a quick view on commercial property? Few questions around that, and people asking is commercial property a problem for banks and the fact that they have a lot of it or lending related to it on their balance sheets, or is commercial property something even worse than that? Could it cause a crisis at some point?
Yeah, it's definitely an area of the market that is being increasingly flagged by investors, and rightly so, particularly given the pain that some of them went through this time last year when it came to the Treasury book surrounding smaller regional US banks. And obviously that crisis then spread to Europe, and we saw the downfall of one of the major banks there. So it's absolutely right to be asking that kind of question. From what I understand, the problem around commercial property exposure really lies more closely with small and, again, more regional banks. They tend to have a slightly higher proportion of their books exposed to commercial real estate. So if you think about the other larger, more capitalized banks, the big names that we can think of, the JP Morgans, the Citis, they've typically got a slightly more diversified asset book, whereas smaller, more regional banks don't, and they have a higher degree of exposure to that space. I think we simply don't know. I mean, we can't say whether it is or isn't a problem at this point. We just need to be aware that of those areas of the market, it's typically the smaller banks that have got that bigger exposure. The good thing is, I think regulation, particularly in the US, is coming down harder on these banks, and they're being forced to recapitalize to a far larger extent than historically they have been. And there's certainly a lot more vigilance in this area. So it's absolutely right to be asking these questions. But I think if there is to be a problem, it's more likely to lie with the smaller lenders than it is the larger ones.
Okay, thanks. So moving on a little bit then, more to kind of investment philosophy. Ian, the question for you first up, and really is kind of looking at the role of both active and passive management in the Progeny asset management portfolios. And in particular, where do you use actives? In what scenarios will you look to use an active manager?
Good question. And look, there's no free lunch with investing, really, is there? And well, I guess the only free lunch is the where we can control costs. So what I was talking about earlier in terms of that philosophy and how we deliver it. So where we think about using passives versus active is where there's the sort of academic evidence, the empirical evidence to support whether you can find alpha, whether you can find a return above the market. So this is a well-used example, but large cap US markets, if you go over 10-year rolling data, the chances of beating the market is zero. So we're not going to apply an active strategy with a higher cost when the probability is zero that you're going to beat that market. If, for example, you look at something like the UK mid and small cap indices, there's a much higher percentage of finding alpha, much higher. So that's when we would tend to pay a little bit more for the prospect of more. So that's really how we think of it. So in that sort of best of breed approach, where markets are efficient, there's nothing wrong with passives, and they'll give you the return of the market, less a little bit of cost. Where there's clear signs and academic evidence, empirical evidence to back it up, and we're very much a data-led business in all the way we approach our investments, and it supports it, then we'll use an active manager at the right price. But coming back to what I said earlier, come back to that buying power, and then you go back to the fund managers, and we can negotiate to bring those prices down. So what you would see as a private client on a retail platform, we can get a much lower rate as an institutional fund manager. So again, that's that controlling cost budget I talked about earlier on.
Understood. And perhaps also a few words around the use of alternatives in the portfolios. What are the kind of alternative products that you like to use? How do you use them? Current exposure. So
a really good example is the real infrastructure. So there's an investment trust in the UK, and it invests in wind turbines. So that is there's lots of the sort of green agenda and sustainability and culture where we're going, but actually real assets are important from an alternatives exposure. So not a correlation with equities and bonds. So we've used alternatives, certainly if you go back to the 2022 to 23, when there was this strong correlation of equity and bond pricing, alternatives were a bigger part of portfolios. I touched on it earlier on that we're starting to see that sort of decoupling again of correlation. So a normalization, if you will, between what equities do and what bonds do. So we've actually dialed down a little bit our alternatives exposure as a result, because we're seeing bonds being bonds again, equities being equities again. So alts have their place as a diversifier. And if I can finish on a sort of volatility dampener, that's how we think about them. Great. Okay. Right. We are fast running out of time here, guys. So I've got one more question for you, and I'm going to ask you to do a little bit of crystal ball gazing. I think I'll start by asking Charlie, and you can have a go at this one as well. But Charlie, in your view, do kind of politics and markets intersect much? And if so, what effect do you think kind of perhaps President Trump, Mark II, or a Labour government will have on those investment markets?
Yeah, it's going to be a frequent topic of conversation going into November, isn't it? Look, I think markets do care, but the reality is that even if we did know what the outcome was going to be, that doesn't necessarily help positioning. If you think about 2016 and Brexit, if we had known the outcome, I still think that people would have been positioned ahead of that in the wrong way. So it doesn't necessarily help. What we do know, though, is that over the long term, markets, despite the volatility, have continued to trend upwards. Now, I think when it comes to, or as and when, or if it comes to a Trump Mark II, he is a notorious foreign policy hawk. I think China will definitely be in his sights. We've seen plenty of coverage around that. But let's not also forget that so is Biden, and he's also been very protectionist, particularly of late. in the reining in a certain software and growing ties with other Indo-Pacific nations. So look, I think knowing the outcomes of these things is one thing, but whether you can get the positioning right is altogether another thing, and not often people do. But I think, again, let's look back at the data and let's continue to remind ourselves that over the long term, these kind of things they create volatility, but markets do continue to trend upwards.
Thanks, Charlie. Ian, do you want to add anything to that?
Yeah, I'll just briefly, I think it's something like half the globe's going to the polls this year. I think I covered in my sort of January market comment. So big year from politics. Markets do focus on it, as just Charlie said. I think in the US particularly, there's a strong polarization of politics, isn't there? And there's lots of data that shows what happens after markets, after elections have happened to markets. I think first point is markets don't like uncertainty. So if you get a protracted situation around who's in charge, that's when the markets have a bit of a dip after it. That there's quite a lot of evidence to back that up. My finishing point, however, is this: that actually we see this as noise. Politics is noise that gets in the way of the markets. And once the noise is dissipated away, markets return to norm and back to sort of my earlier slides about markets being efficient. And really, as investors, we're taking a long-term view. So uncertainty is something the markets hold on to, but you're in it for the long term, and they will ride that sort of wall of worry if it comes out of politics. So it's noise and nothing to get too carried away about.
Charlie, Ian, that's about all we've got time for. So thank you very much for your contributions today.
Thanks, Hugh.
And we'll close the session. I hope you found that useful today. If you do have any additional questions for us, then please either get a hold of your advisor, or you can also contact us via the website if you've got any more questions. I hope you enjoyed the session today. It only remains for me to say enjoy the rest of your day, and we'll talk to you again soon. Thank you very much.